Welcome back to part 2 of our video on data centers. In part 1, we laid the foundation. We discussed what a data center actually is, why they are so important, the different type of data centers, and where India stands in the global ecosystem. If you haven't watched part 1 yet, I strongly suggest you to check it out first. It will give you a complete context before we dive into today's discussion. Because in this part, we are shifting gears. We'll look at the key listed players in India's data center ecosystem. And of course, we'll also talk about the hidden risk that could derail this entire boom. Risk that most people are ignoring right now. So let's get started. Before we look at the key players, please note that in this video, we can't deep dive into each company. And every company has a different business model, growth prospect and key risk. And of course, the big question is, are current valuations justified? So make sure that you understand the business before investing your money. And please note that we'll list down companies from descending order of market cap. So first player in the ecosystem is Bharti Airtel. Through its arm Nextra Data, Airtel is one of the biggest data center operators in India. They already have multiple facilities running and are expanding aggressively. So Airtel is not just your telecom provider, it's also India's largest digital infrastructure company. Airtel earning growth in last few years is exceptional and has been reflected into the stock price with consistent growth in last 5 years. Second and third stock are Siemens and ABB India. These are industrial automation giants. Siemens offering include power supply systems, switchgear, automation and building tech, digital services like monitoring, diagnostics and infrastructure control. Its growth has been fantastic in last 3 years, but trailing 12-month growth is negative. Stock price also rallied a lot post-COVID but has witnessed good correction in last 1 year. Then ABB India supplies lots of critical infrastructure for data centers like UPS system, switchgear, transformer, power distribution and control, monitoring and automation, environment control system and so on. In last 3 years, its earning growth has been exceptional but trailing 12-month earning has slowed down. Its share price zoomed a lot post-COVID but has also witnessed a good correction. Company's valuations have also corrected from the peak. Now everything would boil down to execution. Company does not give growth guidance. Then another interesting name in the data center ecosystem is CG Power. It has been one of the biggest turnaround story in last few years after the acquisition from Murugappa Group. They manufacture transformers, switchgear, motors and electrical equipment that are critical for power supply and distribution inside data center. Company is also lining up big investment in semiconductors and electronic sector. Company share prices also zoomed exponentially in the past, but there is a good consolidation in last 1 year. Valuation although are very high, that is discounted a lot of future growth, but DIs are consistently increasing stake in the company. If you recall, we recently discussed CG Power in semiconductor video as well. Next two stocks are from cooling and heat management segment. Please note that heat management constitute 40 to 50% cost of data centers. So first name is Blue Star, second is Voltas. Both are leader in HVAC, that is heating, ventilation and air conditioning and industrial cooling solution. Beyond cooling, both also provide integrated electromechanical solution like power distribution, ventilation and project execution for large facility. Blue Star has grown exponentially in last 3 years, but growth was in single digit in trailing 12 months. As a result, its share price that zoomed a lot post-COVID has consolidated in last 1 year. Voltas' growth has been also fantastic and that has also got reflected in share price. However, there is a sharp correction in last 1 year due to unexpectedly cool summer in India. But such corrections create opportunity for long-term investors. Now, one of the biggest challenges with data center is getting reliable power into these facilities. That's where GE Vernova T&D India comes in, where they provide power transmission and distribution equipment like gas insulated switchgear, air insulated switchgear, power transformer, circuit breaker, then production and automation system, substation, grid automation solution. Company's growth in the past has been exceptional, that is also reflected in the share price. But due to its high growth, company always command a premium valuation that leaves no room for error. Next important aspect of data center is cables and conductors. Data centers need ultra reliable cabling to ensure zero downtime. That's where KI Industries and APAR Industries comes into picture. KI's presence in EHV, that is extra high voltage cable, makes it relevant for hyperscale DCs that often need dedicated high capacity connections. I've discussed KI Industries long back at very low valuation. Company has been growing consistently at very good rate and stock prices also reflected the same. Although last 1 year witnessed a sharp correction followed with recovery. And net stock is where it was 1 year ago. Again, valuations are premium due to the growth company has showcased in the past and the potential in the future. Then APAR Industries manufactures conductors, specialty cables, transformer oils and polymers. Conductors and power cables are used in grid and substation connectivity. Specialty oils are used in transformers that feed electricity into data center. Cooling fluids are used in transformers and electrical equipment. Now with India's DC scaling up to 50 to 100 megawatt facilities, reliable conductors and transformer oils are essential to prevent overheating, short circuit and failures. Company's growth has been nothing short of extraordinary and has been reflected in the share price. But similar to KEI, its stock price tanked at the beginning of the year and now there's a strong recovery. Next company is Anant Raj. Traditionally a real estate developer, Anant Raj is now turning its land bank in NCR into data center park. Company's growth has been explosive in last few years. It's also reflected in the share price. Although a sharp correction happened during the beginning of this year and the stock has been consolidating. Company has set massive target of 9,000 crore revenue by FY32 against trailing 12-month revenue of 2,000 crore. At current PE, the valuations are not bad provided company can achieve its growth guidance. Next company is Schneider Electric. It is the listed Indian arm of French MNC known for energy management and automation. Company offers power distribution that ensure electricity from the grid is safely stepped down and distributed inside the facility. Next is energy management, where Schneider platform provides real-time monitoring of power usage, cooling and efficiency. It also helps operators monitor servers, cooling and energy flow and hence reducing downtime and cost. Company's top line and bottom line has been growing at exponential rate, which is also reflected in the share price. But in last 1 year, it witnessed sharp correction followed with strong recovery. Company's valuations are of course very rich. The next company is Techno Electric. They don't run data centers, but they build the power infrastructure that includes substation, transmission line, everything that keeps running these facilities. Again, its growth has been explosive, especially in trailing 12 months. But stock price rallied much more than the growth. In last 1 year, there was a sharp correction, but again stock has recovered with net no return in last 1 year. As a result, its valuation has also fallen. Over the next 2-3 years, company's management is guiding for sustaining a 40 to 50% CAGR rate in top line. Now when we talk about India's data center ecosystem, most companies are enabler, supplying power, cables, cooling, but there is one company that is a direct technology play, building the servers and computing system that run inside data center. That's NetWeb Technologies. I remember covering NetWeb last year at very low levels. Their servers and GPU clusters run applications and train AI models. Their high performance computing system powers supercomputing and analytics. Their storage solution holds massive volume of cloud and enterprise data. And their private cloud setup let enterprises build secure, custom mini clouds inside co-location centers. In short, NetWeb provides the compute plus storage backbone of India's data center, and with AI demand exploding, their role is only getting bigger. Its top line and bottom line growth in last few years has been explosive. Its stock was listed in July 23 and since then it's already up nearly 3 times. In last 1 year, there was a sharp correction during the first half and now there's a sharp recovery with very high volumes. But the challenge is very expensive valuation. Market is paying crazy PE to NetWeb due to its explosive growth. So there is no margin of safety. Now when it comes to data centers, building the physical site is just one part. The real challenge is integrating servers, storage, networking and security into a seamless system. That's where Blackbox comes in. It is system integrator where it design and implement complete data center solutions. Its service cover networking, cybersecurity, unified communication, IT infra and managed services. In data centers, it handles setup, cabling, security, cloud migration and ongoing management. In short, Blackbox does not make servers or cables. It ensures the entire data center runs smoothly end to end. Now if you look at company's top line, it has been flattish. But its net profits have exploded in last 3 years due to increase in operating margin, which is in single high digit, and reduction in taxation. Now its valuation might look cheap as compared to other companies, but you need to understand that it is a low margin commoditized work with weak top line growth. So company won't command a very high PE ratio. The next very interesting company is E2E Network. It does not build the physical data centers. Instead, it uses them to deliver cloud and AI services. E2E rent or co-locate inside data center, then deploy their own servers, storage and GPU cluster. On top of that, company provide cloud infrastructure like virtual machines, storage, and AI compute to enterprises and government clients. Company's specialty is GPU-based AI workload which need huge processing power. In simple words, E2E turns a plain data center into a cloud platform that customers can use for AI, cloud, and enterprise application. Again, company's growth has been explosive in the past, but share price growth is even more explosive. In last 1 year, company share price tanked brutally that reflected the lack of liquidity during weak market environment. But stock has again started to recover. As far as valuations are concerned, it's absolutely insane. Last company in the list is Orion Pro. For DC operators who don't want to manage every technical and construction detail, Orion Pro is a one-stop provider where it includes design, build, and consulting. And that makes them a meaningful player in India's DC boom. Company has grown at exceptional rate in last few years and share price also exploded. Although there's a sharp correction in last 1 year. Company's valuations are also not crazy high. Management latest guidance for PAT growth is between 15 to 16%. Now that we have discussed the key listed player in data center from Indian stock market and all positive news in terms of opportunity and explosive growth, it's time to look at the key risk in the growth thesis. Alright, let's have a look. Today there's a lot of buzz for data center stocks, but nobody is really talking about the key risk which is very important before taking a call on buy or sell of data center stocks. Now in my opinion, one of the biggest risks in India's data center boom is valuation risk. Building data center is capital intensive that requires land, power infra, cooling, servers, and constant tech refreshes. But many companies in this space are already trading at very high multiple just on the promise of growth. We have seen this globally. US and Asian data center REITs have had sharp correction whenever interest rate rose or demand slowed. In India, the risk is even higher because many players are new to operating data centers and the hype cycle could be ahead of fundamental. So while the long-term demand story is intact, investors need to be very careful of what valuations they are paying at the moment and whether the growth is already priced in or not. I mean, just look at the valuations of top US companies in the AI sector like Microsoft, Nvidia, Google. For that matter, OpenAI, which is the parent company of ChatGPT, today commands a market cap of $500 billion just for $13 billion sale. That's insane. Now, I don't know how many of you remember the dot-com bust in 2000. Just like today we have AI hype, late 90s was all about the internet. And during that time, I remember Cisco that created the hardware to power the internet, essentially Nvidia of that time, became world's largest company before it tanked 90% from the highs. So my only advice is to be careful. Do not blindly chase the hype. Sure, AI and data centers have a lot of potential, but you need to understand what you are buying and at what price you are buying. And of course, it's very important to build a right portfolio that balance your risk and reward. That's where I have an exclusive community of investors via my weekly video series where I track more than 200 companies and identify right set of investment opportunities. The idea is not to give buy or sell call, but to help you in your investment journey by sharing the right information. For more details, you can explore my website or join button of this channel. One pro tip here is to identify companies where institutions like FIs and DIs or HNI investor for that matter are making fresh entry. So that can give you a good trigger to deep dive further. Maybe we can discuss such stocks in a separate video. Then second risk is supply and demand risk. Today every major player from hyperscaler to real estate developer is rushing to build new data centers. The logic is simple. Demand for cloud, AI and storage is exploding. So let's add capacity fast. But here is the problem. What if supply grows faster than the demand? We have seen this movie before in Indian real estate. Developers built shiny new apartments and office towers, but demand could not keep up. That resulted in vacancy, falling lease rates and poor returns. The same thing can happen in data centers. If too many racks come online at the same time, utilization will lag. If hyperscalers or large clients delay expansion, operators may be stuck with empty capacity, earning nothing. Remember, data centers are not cheap warehouses. They are ultra capital intensive. An idle rack means sunk cost, vested power contracts and lost returns on billions invested. Then there is another angle, that is concentration risk. India's data center demand is driven heavily by a handful of big hyperscalers like Amazon, Google, Microsoft. If even one of them slows expansion, it can leave entire facilities underutilized. Then third risk is supply chain dependence. India's data center rely heavily on important equipments. Everything from high performance GPUs, advanced servers, cooling system, UPS, even cable and switchgear in some cases. Take GPUs for that matter. Almost the entire world depends on Nvidia, and most of those chips are manufactured in Taiwan. If exports ban tighten or if geopolitical tension flare in the Taiwan, India's AI data center build could be stalled overnight. This is not just chips. Data centers are copper and steel intensive. If global commodity prices spike, project costs shoot up. Then a lot of cooling and HVAC systems are also imported, often from Europe or East Asia, which means currency depreciation directly raises capex. In short, while demand is local, supply chain is global, and that creates a huge vulnerability. A disruption anywhere in the world, whether it's semiconductor in Taiwan, cable in China, or turbines in Europe, can delay India's project, inflate cost, and squeeze margins. Then fourth risk is power and energy risk. Data centers are monsters when it comes to electricity. As capacity triples in the next few years, the big question is, can India's grid handle it? If not, operators fall back on diesel generators, which means higher cost, higher emission, and serious ESG pushback. Then fifth risk is cooling and water risk. Nearly half the energy inside a data center goes just to keep servers cool. Many Indian centers still rely on water-based cooling. But think about it. Chennai, NCR, Mumbai, they are already water stressed. Tomorrow regulators could literally cap how much water a DC can use. That can choke the entire future expansion. Then sixth risk is execution and construction risk. Building a data center is not just about concrete and steel. You need land approval, environment clearance, EPC capacity, and a flawless safety system. A single fire or a 6-month approval delay can throw off billion-dollar projects. Then seventh risk is regulation risk. Data protection laws, carbon mandates, state-level incentives, all of this are still evolving. A single policy change can be very costly and can delay expansion plan. Then eighth risk is environmental and social pushback. Data centers aren't invisible. They take land, draw water, burn diesel, and generate noise. On top of this, many facilities are concentrated in flood-prone or cyclone-prone cities like Mumbai and Chennai. Climate risk is very real. So while the story looks like the next gold rush, remember the risks are just as big as the opportunity. So that wraps up part 2 of our deep dive into India's data center story. We have seen how different companies from giants like Airtel, Siemens, ABB, CG Power, Blue Star, Voltas to niche players like NetWeb, Blackbox, E2E, Orion Pro, all are trying to capture a piece of this massive opportunity. Each one has a unique role to play, whether it's power, cooling, connectivity, compute. And yes, the growth numbers over the last few years have been explosive. But we also discussed the other side of the story, the risk. From sky-high valuation and overbuilding risk to supply chain dependence, power and water scarcity, execution delay, and regulatory uncertainty. These are real challenges that can't be ignored. So what's the final takeaway? The data center theme in India is real. The demand will only grow as AI, cloud, and digital adoption accelerate. But that does not mean every stock linked to the theme will be a multi-bagger. Many are already trading at stressed valuation, leaving little margin of safety. As investors, the key is to be selective. Understand the business model, check the growth guidance, and most importantly, don't chase hype blindly. Sometimes the big opportunities are ones where big money is quietly making fresh entries while retail investors are still chasing stories on the surface. In short, data centers may well be one of the defining themes of the next decade. But whether it's a multi-bagger or just hype depends entirely on what you buy, when you buy, and what price you buy. Thanks for watching this video. If you find it useful, do share it within your circle. I'll see you next video. Till then, take care.